you tired of all the uneducated noise you're getting from the droves of YOLO meme coin peddling douchebag gurus out there trying to use you as their exit liquidity? Would you rather learn a competent university level set of skills that will guide you in managing and investing for the rest of your life? Join us 3 days a week at Digital Investor. Develop your knowledge of game theory, cognitive bias, macroeconomics, monetary theory, investment theory, psychology of the crowds, and more. For more info on Digital Investor and how it can help you, reach out at nickblacknext.com.
Hello, hello. Hello, hello, hello. What is going on? Let me get my hellos done. You're already rich, Cisco. You're rich in auto knowledge. That's a richness that will never be outdone by robots. Wait. No. All right. Okay. So if you have questions, go ahead and knock your questions out. Today, we're going to talk about something that probably makes a lot of sense. Navigating financial downturns. I'm starting to see it. The little whiny comments. All the crap on Twitter, although, that place is a dumpster fire cesspool anyway. Did you know yesterday, over $40 million in leverage got wiped out from people leveraging Dogecoin? That is mind-boggling. Like, think about that for a second. A meme coin where the people that created it said it has no value. Like, no value. Think of all the dumbasses that are taking leverage. That means they're borrowing against Dogecoin for more Dogecoin. What a bunch of dumbasses. Like, it doesn't even make sense. But there you go. Howard, you can't say I have a question. You have to put the question, but it can't be a dumb question. If it's a dumb question, I'm just going to ignore it. There are no dumb questions, except for sometimes the ones that Howard asks. Okay, why must it spin? You don't like the spinning stamp, Barry? If you blink really fast, it's not spinning anymore. It's clicking. Let's see. Days to green was wrong. No, days to green was correct. We didn't say days to bull market. We said days to green. Bitcoin. You guys remember what Bitcoin was on January 8th, correct? Let me refresh the memory of some of you narrow, very narrow, echo chambery people. Let's go look at markets just for a minute. All right, let's see. Let's go back 12 months. where were we on January? This was when we did our days to green, it was right around here. It was right around 43. That's where it started. Okay. So 43, 40. Well, let's take it from the high. 46. I didn't quite get 47. It was at 46,000. It was at 46,000. Could anybody do some quick math? Is 46,000 more or less than 65,000? Just real quick, anyone. Just grab that calculator. Just real quick. 46,000, 66,000. Green or no? Yes or no? Green? Not green. All right. We don't like that. All right, let's go to another one. Let's go to Ethereum. Let's see. January. We're saying January 10th-ish. January 8th to 10th. Okay. Is 2,382 less or more than the current price of 3,400? Is it less or more? Let's go to another one. No, let's not go to another one. You guys are being a bunch of whiny pussies. A lot of you. A lot of you. You guys, none of you saw, most of you have not been in the crypto space long enough to have ever seen a bull market. So when the market went up, it had been flat or down for a year and a half. People were doing good fundamental analysis. They were investing in quality projects, or at least so they assumed based on the quality of the information. You did your research. You bought into companies that you thought were good. They went up whimsically for a few months. And now everybody thinks that's the only direction markets go. And how could they ever go backwards? Many of you skipped taking your exits on positions that were well in the green, that were well within your limits, your 10x take 20, 2x take 10. But you decided no, you know more than math. So you're going to wait it out. You're not going to sell. You're not going to sell too soon. So you held on to stuff as it ripped right back down. There was a saying in 2017, you don't deserve the 39,000% upswings if you can't take the 90% downswings. Right? It's still a 4x. So the fact that the market's been down or sideways for 60 days, for 2 months, woe is me. Get off the gas. Stop being whiny little bitches. And what did you expect? Ferrari factory for everyone because you've been here 16 minutes? Get the fuck out of here. You guys got to put your adult clothes on. I usually only see this in the beginning of the bear market, which we haven't even really hit the bull market, in my opinion. So we're not even at the green part yet. And already you're starting to melt into the FOMO-y, anxiety, fear-driven, panic-driven, can't sleep at night, whiny ass motherfuckers. Stop it. If any of this stresses you out, any of it, sell all of your shit and get the fuck out of investing. Honestly, be a fucking adult. You guys got to wake up, man. I've seen so many people destroy their portfolios because when everything's going good, of course everyone's happy. When everything's going up, woo woo. Look at me, I'm so smart. Everybody's telling everybody how smart they are. I'm smart. Woo hoo. Going straight up. Look at all this green. Woo. Then it goes down for 2 weeks. Well, what's wrong? What do you mean what's wrong? You weren't saying what's wrong when it was going up. Isn't it the same? Like, you guys got to think your way through this stuff. Nothing is in a straight line, man. Oh, dear God. I'm going to read this because it shocks me. Howard likes sitting in the nude. Quit yelling at us. I ain't trying to hear your shit, Howard. Shut up. Listen in the nude. Sit there naked in your moist, naked repose, and you listen to this lambasting that you all deserve. You guys are acting, not all of you. Not all of you. I would say 2% of the group here. But man, you go through Twitter for 13 seconds. What a bunch of idiots. And what happens is the gambling gets more. It intensifies. Because what people do, then they go, oh, I got to make it. I got to make it up. I got to make up lost time. You ain't going to make up nothing. You don't get to make up. You don't get to catch up. Oh, I'm 10 minutes late for the start of the NASCAR race. Can you just tack me on some laps so I can catch up? Bitch, you lost. You're down by 20 laps. You will never catch up. You can do good against your own portfolio. This is why we take programmed exits, bros. Cephasuses. This is why when your assets go up, you take exits. It doesn't matter what you think might happen. You take programmed exits. You put cash on the sideline and you don't immediately redeploy it when it resets by like 13 seconds. Oh, I sold it $4. It's down to $3.90. I'm going to get back in. I'm going to crush it. No, stupid. Quit reinvesting. Take your money, put it on the sideline, get quiet. See, yeah, this is when you can yell. Ah. It doesn't matter the number, Howard. The number doesn't matter. I promise you, I'm down on paper more than any of you here are, more than any of you, maybe more than most of you combined. I ain't crying me a river. This is all part of it. You look at the overall, kind of cycle. So let's say 2014 to end of 2017. Well, we kind of let's go mid 2014 to mid 2018. Okay. I got during the up times of that market cycle, we'll call that a bear and a bear into a bull market into a bear market. So down, then up, then down. I did about 128x on my money. Then you had 28, after the first quarter, 2018, everything S the bed. 2018, 2019, 2020, then we're going into COVID. So here comes the funny money, but then there was the next bull market, late 2020, 2021. So that was a good, good 2.5 years of downtime. When the market recovered 2021, and of course, a lot of that was in bull crap and swamp gas and crap like that and vapor. And the spammy NFT phase and also, the scammiest of the DeFi stuff was launching. And I made, let's see, like a 28x. So I did because it was like a 120, it was like 129 or 128x. Then things settled down and probably, so what did I go down? I probably went down 70% between 2018, 2019, 2020. Well, I'd say that I probably on the assets that I held, they probably retraced about 70, 75%. I just sat on stuff. If I believed in it, I sat on it. I did do a lot of arbitrage trading in 2018 and 2019. 2018, 2019. Then Bitcoin started recovering pretty well. So, and then 2021, then you had the real big pumpy stuff. Okay, then 2022. So then I did about another 28x. I'd have to look, but somewhere in that area, in the 20s, in the high 20s. Then, but what changed is after the first run I did in 2018, the first time that I saw my assets get nuked, I had started taking money to cash not because I thought the markets were going to crash, but just because I was like, well, I can't be all crypto all the time. Even if I stay in stable coins, I have to have some dry powder. So that's why I started formulating that idea. And I saw a lot of people taking a bunch of leverage back in 2021, 2022. That's when I got scared of that. So then I said, okay, I got to get more cash to the sidelines. I need to have 10 to 15% in cash, but I'm not going to redeploy. The first time I probably redeployed, I would win and then redeploy it, win and then redeploy it, because things only went up. Then the second cycle, I realized things don't go up, and I just watched people taking leverage. And every time people took leverage, when I saw them talking about leverage and people just getting wiped, I was like, okay, there's too much borrowing going on, too many gamblers. And the gambling has intensified. People are gambling more and more and more and investing less and less and less. If this GameStop bullshit teaches you anything, it's that, and you really got to go watch that podcast that Patrick Boyle did on like investment and financial nihilism, where people believe in nothing, they trust nothing, there are no such thing as facts, everything's a scam, everything's a lie, there's no such thing as fundamental analysis, nothing has any value at all ever. And so it's all about just gambly bullshit. Gamble. Like, why would I have a full career if I could just gamble? I don't have time. I don't want to work for 20 years. I'll just gamble. Every single paycheck I get, I'll gamble all of it. I'm willing to live a life of squalor or poverty or indebtedness or indentured servitude to credit card companies that use compound interest against you in predatory ways, by the way. Credit debt is predatory, really bad. Well, that's a whole other thing. Anyway, go look at the repeal of Glass-Steagall if you really want to see. God. Anyway, so I started to realize that like this leverage thing's getting out of control. Even people that I thought were pretty smart are just taking on huge leverage. And so this mentality has gotten bigger and bigger, but still over time, over history, financial markets are veterans being patient while rookies and amateurs slowly give their money away to veterans through panic and FOMO, buy high, sell low, like zero analysis, culture investing, gang investing. Buddy, if you get your marching orders from Reddit, you're a fucking idiot. Like, really? These guys, man, a bunch of creeps. And I will say this, at least the admins in those groups were like, I don't know about this, man. This doesn't feel right. Even the admins in the groups that were pumping GameStop were saying, I don't know, man. This doesn't feel right. It doesn't feel right to give a bunch of money to a company that squanders it and can't manage a company. Why are we giving them more money? Because we're gonna hurt like three rich people. We're gonna hurt three rich people. You're not gonna hurt rich people. Rich people still rich. That's the whole point. They're not behaving like you. It's not like the people on the other side of the table when it's, these game stoppers and, all of the meme stonks, AMCs, and all. It's not like the people on the other side of the table are behaving the same way that the gambly, bullshitty YOLOs are. It's not the same. They're not over there doing the same thing, but on the short side. Oh, panic. Bro, stop. Like, there's a reason why they're, billionaires many times over, or why their firms have massive amounts of money and why they're willing to risk. And you say, well, it's rigged. Some of it's probably rigged. There's some bad behavior and perverse incentives and, morally and corrupt individuals, but not everybody. The whole system's not corrupt. There are parts of it that are corrupt, but if you know that, you can game it. You can game it through buying quality assets that you believe could achieve use utility and wide scale adoption in a market where you can better compete, which is the crypto space, and in a sub market like artificial intelligence, which is a space within a space where you think that there's at least not information asymmetry, meaning at least you have the same information the they has, and you can invest based on your own version of financial discipline, version of, risk tolerance. So when you see this behavior, yeesh, you should be scared. When you see this meme coin behavior and the GameStop and all that, it doesn't matter if we're in a bull market or a bear market or whatever kind of market. When you see that kind of behavior, people are kind of at the end of sanity. So that the world is in a recession. It's like beyond obvious. You may not agree with that, but every piece of data, every single piece of financial data confirms that, like, overwhelmingly. But you may not agree, and that's fine. But if you are in the camp, which is 99% of people that understand math, that the world is in a tight place, that people have less money than they did, or they have the same amount of money, but that buying power has been weakened, and that they are in debt, and that they have taken on too much leverage, and then people become hopeless, there's not a lot of jobs, they start gambling. Or they're stuck in crappy jobs because they're too scared, they're too risk averse to go, and maybe they should be, because they have a lot of bills they have to pay and all this, so they don't want to go look for another job because they're scared. So you have an environment like that, and people are living off credit cards until that stops, until you don't have any more credit card space left, until you've hit the ceiling on all your credit cards. Then what do? Now it's about just managing debt service. Hopefully that works. Hopefully it doesn't. Why do you think we bang the gong all the time on getting out of debt? Just imagine this economy, and this doesn't apply to a lot of the people here, but I promise you it applies to a lot of the people that the people here know. I'm sure people that are in bad financial situation of their own making, like they made their bad financial bed. Lots. And so you can see where people are at, right? Psychologically. So if everything looks dark, people become hopeless and they just start gambling. And we're in the gambling phase right now. And it has nothing to do with crypto, not really. This isn't a crypto specific thing. Okay, the market sold off 20, 30%. So what? Go to the 90-day, go to the 1 year. Let's just go to the 1 year. Are you winning or losing on Bitcoin? Winning. Winning or losing on Ethereum? Winning. XRP, oddly, break even. You're winning on Dogecoin. You're winning on Cardano, which, again, so all these low, oh my God, everything's crashing. Right. You're up 43%, 44%. You're up on crap and Polkadot, 30%. Matic, okay, you're down by 8%. You're up on Uniswap if you're a participant. Monero doesn't count. You're up on Fetch. It's sold off. It's completely in the toilet. Yeah, but you're up 540% in that thing that's in the toilet. 540%. You're up 260% on Render. The spammiest, bullshittiest, copycat ass, spacky, garbagey asset. They'll just say anything to get you to buy their token. You're up on that 260%. You're down on Cosmos, 24%. Unless you're staking. If you're staking, you're down 3%, because you've been getting nearly that with compounded interest. You've been getting about 20, 21%. But I digress. Filecoin, it's all the way down to where you're up 18.5%. Optimism, you're all the way down to only being up 60%. VeChain, 70%. Graph Token, 100%. Arweave, It's cut in half and you're up 418%. Algorand, maybe the crappiest asset in this whole bunch. You're up 15.5%. Jupiter, break even, because it hasn't been around that long, so we don't know. AGIX, you're down to 135% gain. Hello, common sense. Everybody here that's been here long enough to know some financial common sense is up at least a double on every single thing you bought. Except for Howard, who bought a lot of Algorand. But everybody else. So, we are in a very enviable spot. And by the way, many of you, because of how far these things moved, you're up far greater than that because you took some money to the sidelines and hopefully you didn't just redeploy it. You didn't just punt it back into the markets. Question. Okay, here's a legitimate question. Could you see all this coming? No, I couldn't see it coming. I just was scared of the behavior of all this meme coin stuff. When you see that kind of behavior, you know things aren't right. And it doesn't mean that markets are going to crash, but it means that crap is going to crash. Look at Bitcoin. On the 30-day, it's down 3.5%. On the 7-day, 3.5%. On the 24-hour, it's down 1%. Everybody's like, oh my God, woe is me. It's the end of the world. What is the end of the world? If you bought the most boring, lame-ass asset on the planet, you're up almost 150%. The altcoins sell quicker because, people care about them less. You sell the crap that you don't love first, and then eventually you sell everything. In a chaos situation, everything is correlated 1, full integer, a whole number. That means like 100%. It's all correlated when there's panic. There's panic when dummies start behaving in a way that is like, nihilistic. So you just have to rise above this emotional pettiness. It really is petty. So it's real funny. I used to have people that don't know shit about crypto and they just know that you're into it. And then, that Bitcoin will go down for a few days. They'll be like, they'll call you up. You haven't talked to them in a year and a half. They're like, hey, or they'll text you, you okay? Yeah. Cause they're telling their friends, man, my buddy's in crypto. He's getting crushed. He's getting his face ripped. Yeah. Yeah. I'm doing fine. I bought Bitcoin at $692, motherfucker. I'm doing okay. And I don't mean like, oh, I got in so early and all this. The point is, if you're investing smart, and smart means do your 5 T's. See, what are the 5 T's? Why does he keep saying that? You guys know this. Everybody here, there's 191 people. What are the 5 T's before I put the banner up? I'm going to put the banner up. I'm going to give you a few seconds. I want everybody. And then for those of you that don't know it, you can copy the banner. What are the 5 T's? This is the way that you first look at a project that you think might be interesting, right? That might be valuable. You look at the team, you look at the timing, you look at the technology that they're using, you look at the tokenomic structure, who owns what are the lockups, that kind of thing. And then you look at the token and you say, why does this token exist? Why token? You know what I mean? This is where it starts. So by doing that, I give zero. From zero, I never used to give zeros out until Singularity DAO. You go from 0 to 5 with each one of these. You look at the team, the timing, technology, tokenomics, and why does the token exist? And if you get a number between 15 and 18, to me, that makes sense that you could make a play on it. Now, what is the play? Is it going to be an investment, which is a long-term, you're going to hold for a year more, or is it going to be a trade, which is from 1 second to a year? I think if it's in the 15 to 18 range, it's a trade. Meaning, yeah, I like it. It's cool. It's not like, knocking my socks off, but I'm willing to give it a go. If it does a double or a triple, I'm taking my original money off the table. Okay, so it's a little bit different rules based there because you don't believe in it as much. If it's an 18 or better, I think it's in the investment category. And investments, in my mind, have the potential, they may not reach it, but they have the potential to do a 10x from wherever they are at that moment. That's an investment. Say, cool. I'm not going to cut myself short. If I think this thing could do a 10x, I'm going to be sitting on it. I'm not just going to throw it away. So then, after having done that and giving it a score, I go, okay, cool. Can this asset achieve use, utility, and wide-scale adoption? And that's tricky. Those are, no one doing all of this just gives you a way to kind of frame your investment, to create an investment thesis and how to express it. You express it through what you might buy to take advantage of what you think the market might do. So you have this thesis after having done your 5 T's that then this thing scoring of between a 15 and an 18 could achieve use, utility, and wide scale adoption. And if you think it can do those things, and all you can do is guess. But if you think it can do those things, then you got yourself something that you could then invest in. So these things that we do are to remove emotion from investing. That's the whole point. You have to get, you have to become math based. You have to be purely game theorist. Like when you're driving in traffic. And real quick, one, if someone cuts into the lane that you're in, they didn't cut into your lane. Think about how a lot of people frame that. They cut into my lane. That's not your lane, bro. Everybody shares all this stuff. It's everybody's lane. It's taxpayers' lane. So after a car dangerously swerves into the taxpayer's lane that you just happen to occupy, the lane that you occupy, do you get angry or do you just make an adjustment? Think about this. You're driving in a lane, the lane that you occupy, and it gets stopped up. So you move into another lane because you don't want to be stuck in the slow lane. And then that one gets stopped up. And then all the cars that you were in front of start passing you by. Does pride make you stay in the slower lane, or do you just go back into the lane that is now faster? Think about that. A lot of people get prideful. This is in investing too. I bought it, therefore it's good. No. Information can change. The lane can slow down. It can also speed up. Well, we can't help you. We don't control that. So, the way you frame things does start to shape the way you think about things. So the whole point of the 5 T's and the whole point of looking for use, utility, and wide scale adoption, and the whole point of dollar cost averaging, and the whole point of having a game theory based foundation for thinking and paying attention to your cognitive biases. The whole point is to get emotion and all of that spammy, emotional, bullshitty behavior. Remember, your emotions are just coping mechanisms for back when we lived in the fucking jungle. We don't need that stuff anymore. Now, I'm not saying that you should be emotionless. I'm saying in investing, don't become a lazy-eyed psychopath carving up people's kidneys. That's not what I'm saying. I'm saying is in the investment space, you need to be a lazy-eyed psychopath carving up people's kidneys. All right? This is where in investing in general, in any of your investments, not just AI, not just crypto, not just big data, not just in any time that you part ways, you trade time for currency units and currency units for speculation. You need to remove all of the emotion. Any emotion is going to slow you down. Why do you think we hammered the gong, like beat the gong, hammer the drum, what would you hammer? Well, why do you think we talk so much about cognitive bias? Right? Because these things derail you from thinking clearly. Cognitive bias steers you in the bad. It is a, I'll put it up. And I want everyone to write it. There's 190 people. Let's see it. You can shorten it. Cognitive bias, the tendencies to think in certain ways that lead us to systematic deviations from a standard of rationality or sound judgment. Why do we make the decisions we make? To make it simple, cognitive bias leads to deviations in rational thought. Cognitive bias leads to deviations in rational thought. So they will create forks in the road where there shouldn't be any, or they will steer you towards biased or emotionally biased decisions. Why everything we do is rules-based. Create rules. They don't even have to be my rules, but you have to have some rules of your own. You have to be rules-based. You employ game theory. What is game theory? The study of mathematical models of strategic interaction between rational decision makers, SIPG. The strategic interdependence or interactions between players in a game, SIPG. So the way that you model thought needs to be, okay, first, I have a base of game theory. I'm going to think and behave logically and game theoretically, because this reduces emotion and I can make good, rational, sound, consistent decisions. And my peers don't. They YOLO and do spammy bullshit. So I'll always be better than them just because I'm not as bad as them. See, you don't have to be a genius to look like a genius. You just have to not slip and fall every 15 seconds. Or watch reality TV. Those two. You gotta do those. So, game theory is the way you think, right? Cognitive bias are these kind of crosswinds and headwinds that push you off course. That if you're aware of them, you will interact with them less and less, which again makes your aggregate decision making better and better and better. Among your peers, you just melt up. You melt up. You know what? Here, game theory. If you're running from a serial killer with a mask and a freaking hatchet or whatever, or any scenario where you might be in the woods running, pick your damn feet up. Every single person, look, serial killers, Jasons, Freddy Kruegers, they never run after you. They walk after you. So all you have to do is just walk a little faster and not trip and break your ankle. Every one of these assholes trips and breaks their, you know what they do? They look back as they run through the forest. Guess what? What's behind you is not that important. You just keep on keeping on. Game theory of running through from a Jason. Right? Just pick your damn feet up, sloppy ass. You live. So that's the way it is. That's like the way this works. You make consistent decisions. They don't have to be genius, Elon Musk level. Well, that's in question. They don't have to be genius level decisions. All you have to do is make consistently good decisions, and that's better than the bad that everyone else, statistically, everyone else makes. So you just melt up. Your aggregate decision-making gets better and better and better and better because everyone else's decision-making is so fucking sloppy. It's so sloppy. You know, anyway, there's a lot of examples of this. But the beauty of game theory is that you're modeling these strategic interactions, this kind of interdependence between people in different scenarios, and you just start to use this as a system to analyze, economic competition and other economic phenomena like mechanism design and bargaining and voting and auctions and voting theory, like we're going into the elections, and the behavior of groups and fads and trend chasing. And you start to realize, like, wow, this helps me like dial out all of the noise, right? That's the key. Dial out all the damn noise And part of the noise is internal. It's us. We're the ones being noisy, like self noise. Oh, I don't want that. A little. So, okay, let's do this. Let's switch gears. Now that, well, we're not really switching gears. We're continuing. We're going to another gear, but in the same transmission. Let's get to our main kind of subject of today, which is navigating financial downturns. Most of you got into the crypto space probably when it was going up, and that's probably what sucked you into it. What magnetized, what allured you? Look at all this stuff going straight up. But then you get a downturn and you start to second guess. Oh man, did I make a huge mistake? Am I stupid? Oh no, crap. Have I blown it? They say, well, don't invest money you can't afford to lose. If you traded your life, moments of your life for money, then you can't afford to lose any of it. And if you're in a position where you think you're going to lose it, now, I think maybe the statement should be, don't invest money that you need for rent and food. That's probably better. Rent and food. So, things don't just go straight up. And even when they do, the entire market doesn't go straight up all the time. There are little periods where everything's correlated, but mostly things start to decorrelate and depeg. And you'll get, Bitcoin pulls a runner and Bitcoin goes to 79,000. All of a sudden, everybody's happy. I won't have all these sad faces. Oh, why is everything going down? Well, why is everything going up? Well, listen, if you were on the other side of that, if you were shorting it, now you have the sad face. So it's all perspective, right? But you need to have a process for dealing with the bad. See, for me, it's flip-flopped. The way I look at it is the only time you can invest is when things are down. And once they're going up, you're stuck on the sidelines, just watching. You've become a bystander. You're not really a participant. So when I see these markets going down, I start going, okay, cool. As long as I'm buying quality assets that I believe are going to be here a couple years from now, then I'm buying stuff at a discounted rate, or I'm rebolstering positions that I now think are going to be stronger in the future. But you need you have to systematize this. So that's what we're going to talk about for a few minutes. So forget about money for a second, and let's talk about financial downturns. That'll be fun.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Okay, so let's talk about a critical aspect of financial literacy. Everybody's okay when things are going up, but how do you navigate the psychological challenges of declining financial markets? So we're going to go into the psychology behind your reactions. We're going to look at coping mechanisms and how relying on your initial research, your 5 T's, your fundamental analysis can guide you through tough times. If you just focus on the math, right? There was a great saying. It was like, because math stupid or something like that. Because math, comma, stupid. It's really funny because if you read it wrong, you sound dumb. Anyway, so we're going to frame the discussion like we kind of mostly do, and that is game theory as the fundamental process for thinking, cognitive bias, which could derail us, and what is a good strategic approach. First, let's talk market psychology. The emotional a roller coaster. So when markets are declining, it is very natural to feel, the normal kind of emotional kind of spectrum. So you get scared a little bit, anxious, you start second guessing, you may panic, especially if you've taken on leverage, which nobody here does, but right? Nobody here takes on leverage. Matter of fact, everybody here needs to write, I will not take on leverage in investing. Anyway, Carry on. So when markets decline, it is natural to feel these emotions, and they can lead to very impulsive decisions that are often quite detrimental. And, think about it. Think about all the fundamental analysis that you did to get here. Yeah, skeletons. These are all the people that took leverage. Like, it's too late for them, but it's not too late for you guys. So when you understand the origin of these emotions, it helps you react less to them. I mean, they're going to be there to some extent. They're going to be like knocking at the door, like, hey, click, click, click. He's like, nope, no. So first, let's talk loss aversion. This is the cognitive bias that explains that the pain of losing money, like the pain of a loss, is more intense than the pleasure of a gain of the same amount. Losing $100 is like a -3. Winning $100 is like a +1, right? And so this bias can cause us to make very irrational decisions to avoid losses, even when it's not at your best interest. Like, you have an asset that is in the gutter and it's going down, and the information has changed, and it's probably time to cut it free, but you don't because you're underwater and you don't want to take a loss, right? That's the loss aversion kind of thought process. Then you have herd behavior. And this is especially relevant right now. In a declining market, it's very common to see a bunch of other people selling off their investments, right? And it can cause a panic. It also causes leverage to unwind, which causes more of selling and more of panic. So herd behavior is driven by the fear of missing out and the desire to conform, especially among your peers, wherever you consider your peers. And this leads to what? Mass sell-offs. And it is the people that are mass selling off are directly inversely proportionate to investor IQ. It's the people that don't know anything about what they're investing in that panic and sell first. I don't, except in 2021 on Robinhood, when most of the people that were getting on to trade GameStop, they didn't know how to do a sell order. They only knew how to buy. That was like one of their main customer service things, was like, how do I sell? Like, you damn idiots. Like, that's how dumb. When they called that movie Dumb Money for a reason. People dumb. Anyway, so let's talk game theory in declining markets. And what's going to come up is the prisoner's dilemma, most likely. So consider the market as a large-scale prisoner's dilemma scenario. Each investor faces the choice of either holding on to their investment or selling. The optimal strategy, obviously, when thinking collectively, would be just everybody hold. That's the Bitcoin hodl until you die, right? Assuming that the assets and the fundamentals are strong and consistent, that the information hasn't changed. However, fear can drive individuals to defect, to sell. And that can lead to cascading liquidations from people that were gambling, that don't know what they're doing in the first place. This leads to the suboptimal outcome of the price declining for everyone. Everyone gets punished because a small percentage of dummy, right? Again, this is assuming the story hasn't changed and that the math hasn't changed. If the information changes, then you have to go with the new information, or at least you have to be cognizant of it. So then there's the cooperative strategy. If investors collectively decided to hold on to their investments based on their initial analysis, then the market could stabilize much quicker. However, this requires a pretty high level of trust, and it is very rational behavior, which right now in investment markets is quite lacking. And yes, that's a good question. Is there a breaking point where the dummies can't borrow? They fatigue. At a certain point, the dummies fatigue and they run out of money. And when a bunch of leverage unwinds and people get destroyed, they go away for a while. That's why markets are in cycles. Peak stupid. It's the math. Maybe that's it. It's the math, stupid. Is it? It's the math, stupid. It's something like that. It's the math. Something like that, Howard. Yeah, you're pretty much onto it. But yes, there is a point where the dummies can't dummy anymore. If you lose all of the money on your paycheck 30 weeks in a row, at some point you're just fatigued, man. You give up the ghost. You're like, oh, fine. Just fine. I can't. And why do the tokens drop simultaneously? Some of it's trading bots, but some of it is that a lot of these assets are pegged to the price of Bitcoin and Ethereum. So when Bitcoin and Ethereum sell off, even to a slight degree, all of the assets sell off because it's kind of like that's the stable coin. Like Bitcoin is kind of the sensor asset, the litmus asset, Bitcoin and Ethereum. So when they go down, everything kind of goes down, but altcoins go down more because they're less liquid. So less liquid is going to have bigger spreads, more illiquidity in the order books because they're assholes and they're not using OTCs, right? Real OTCs, because OTC trading, nothing would happen. Like the price would not change at all. It would be the last market price, but people are stupid. They choose to go to low liquidity DEXs and act like assholes. Anyway, I digress. So less liquid assets have bigger spreads, weaker order books, and so the pain of selling more deeply inflicts wounds on the prices of those assets. And also there's a lot less trust in those assets. The further you get from number one, the further you go from Bitcoin, the riskier those assets are. The Bitcoin chart, the cryptocurrency chart from 1 out to 10,000 is also like a risk curve that looks, goes straight up almost. By the way, did you guys know that Fetch was the biggest loser in the top 100 tokens? Did you guys know that? Well done, Fetch marketing team. Well done, AGIX team. Well done, Singularity DAO team. You guys, man, it sucks. There's a couple people over there I like, but not enough. Not enough. Those guys they're not big on common sense over there. It is what it is. Anyway, that's why you'll see a lot of assets drop simultaneously. And yes, there is a point where the dummies can no longer dummy. When they've been beaten up enough, they just don't get off the bench. They're just like, the coach is like, you ready? They're like, nah, man, I'm just going to go spend it on weed and gummies and some more woke drug bullshit. I'm going to call it like mind enhancing, but really it's just drugs. But I'm going to say that it's mind enhancing because I got to stay woke, but really it's just drugs. Because the futility of normal life besieges me. So I will imbibe. The dude imbibes. That was the dude abides. Anyway, let's get back to it. So, again, in a cooperative strategy, investors would collectively decide to hold as long as the information hasn't changed from their original, like their 5 Ts or whatever their original analysis would have been. And the market would stabilize much quicker, and those unwinds would happen quicker. So then we go into a tit for tat situation. Get your mind out of the gutter, Howard. I know what you're thinking. No, this is a practical application of game theory where the context is the tit for tat. It suggests starting with a cooperative approach, meaning holding investments and then mirroring the actions of the market. So if the market stabilizes and shows signs of recovery, continue holding. If it continues to decline sharply, consider reevaluating your position based on new information, because you have new information, and price information is also information. So you got to factor it all in. So now let's start to look at cognitive bias and coping mechanisms in downturns. When markets decline, there's a tendency to seek information that confirms either your beliefs, whether they are fear or greed, in the market that will continue to fall. So what does it mean? This can lead to skewed perception of reality. If you read a bunch of articles saying, oh, it's going down, you start to think, well, I guess it's going down because all the articles I read, like, yeah, but you just read the articles that agreed with what you already thought. So is that accurate? So it can give you a skewed perception of reality. Be careful that you're not just reading articles that you already agree with. Look at the information in as close to totality as you can. Coping mechanisms. Actively seek out diverse opinions and data that will challenge your current beliefs. Kind of always be re-5T'ing, so to speak. It's not just like you did it once and that's the end of it. You need to continue some 5Ts on a regular basis. And it'll give you a more like balanced perspective, and it'll help you make more rational decisions. And that's the key. This is the money ball of decision making. Make more rational decisions, consistent rational decisions. Get on base. Let's talk anchoring bias. This bias involves relying too heavily on the first piece of information you received. Most of you, if you took any psychology classes, you'll obviously talk about primacy versus recency. So this is kind of that. And so a lot of people will bias like the initial price you paid for an asset as part of that information. But remember, what you paid for something, that's information for your rules-based approach to exiting. It's not information on the asset itself. Other than that's when I entered the position. But that's not information that is germane to the story of the asset. So revisit your fundamental analysis. All right, revisit it. Consider the intrinsic value of your investments. If you can reduce things to value, again, value at some point just equals happiness. But don't focus too much on current market price. Come up with your own intrinsic value argument. And this can anchor your decisions in more rational thought, more rational analysis, rather than, everybody's buying it, I should buy it. Oh, everybody's selling it, I should sell it. I'm missing out. Okay. No, you're not missing out. Trust your research. When you initially purchased your asset, you probably conducted more thorough research and analysis than at any point after that. Trust in that process. If the fundamentals of your investment have not changed, then there's a strong argument that you should not change. You should not stray. If you still like it, dollar cost average, if you can afford to. If you don't, sell it. If you're losing sleep, deleverage. Get out of the asset. Cut your position, right? If you bought a company's token based on its strong balance sheet, innovative products, and solid management team, all stuff, and everything's the same, even if the market turns down, if everything's the same, there's no reason to exit, okay? The price isn't agreeing with you, but you're not selling today. You're not retiring today. It doesn't matter. Have a more longer-term perspective, right? This is probably the most important thing is patience is a strategy. If you wait by the river long enough, eventually the bodies of your enemies will come floating by. Time and time again, this has been something that investing-wise is why I've passed up a lot of people. If you buy quality and you believe in it, wait by the river. The bodies of your enemies will come floating by. It's like having a winning hand. Just wait until there's a ton of chips on the table and cash it in. So look at historical data. Don't trade by it, but look at it. And many of the most significant market downturns were followed by massive recoveries, like face melting. And then 2 weeks later, you don't even remember the market was down. Right? Diversify your investments because that will help you mitigate the risks associated with sector-based market downturns. Also, just overall downturn in the market. Things, retracement. That's a good statement because most things revert to the mean. Things always revert to the mean. Things always go back to average. This is the reason a few weeks ago, because I've been telling people, Arweave, AR token, it went from a little bit under $4 to $49 in less than 6 months. Not really based on information that I could rationalize. It seemed bullshitty to me. It didn't seem right. And I was like, at night, I was like way up on it. I was like, man, does this just feel like something's not right? Like the whole market would be down 10% and it would be up 18%. That doesn't make sense to me. It felt bullshitty. So after like the second night of just considering it when I should have been sleeping, I was like, I'm out. I was like 4 a.m., 4:30, I'm out, done. All of it. See you later, bye. Nuked. I think I bought Ethereum, and I just went into like kind of stalwart assets, things like that. But and then I kept most of it in cash. Because I didn't think things didn't seem right. Then so I just went back to stable coins, things like that, and some Ethereum. So, diversifying and being aware that if the information's not adding up, make a change. But diversifying's cool. I like the idea of having some store of value, some infrastructure, some layer 2 exposure, some big data exposure, some AI exposure. Because when one sector gets nuked, sometimes you'll have another sector in a diversified portfolio that's performing really well. Like, for instance, last year, 2023, most of us had an amazing year because we were early into AI, and the rest of the market wasn't doing much of anything. It was kind of crap in the bed, but AI crushed, so we crushed. So anyway, game theory and cognitive bias. If you understand these two things, you will statistically make better decisions. And then market downturns, upturns, upswings, downs, loss aversion, none of that's going to apply to you because you won't care, because you'll know you're doing the best thing at the time, right? So it is challenging navigating declining markets, sometimes, emotionally challenging, but by understanding the psychological biases that are influencing our decisions and applying game theory principles, being aware of cognitive bias, you can make more rational and strategic choices. Trust in your research. Trust in your original 5 T's and your analysis that guided you in your original purchase, your original investment. Maintain a longer-term perspective. Don't think 3 minutes into the future like these idiots in these communities that you know who I'm talking about. Think longer term. Live in your mind 12 to 18 months into the future so that you can front-run group thinking. Right? Use effective coping mechanisms. If you need to put a damn rubber band on your hand every time you get depressed and like pop your wrist, do it. Every time you care about the price, other than as a mechanism for you to dollar cost average, snap out of it. And remember that this market, investing is a game. This is a big game. It just is. And if your best moves are informed by discipline and patience and strategic thinking, you will win more consistently, and they will unfortunately give you all their money. That's what it is, man. It is rookies and dummies and YOLO-y, spammy assholes giving veterans all their money. That's investing, bro. Anyway, let's see. What do you got for us there? With the ASI token, will they keep pumping until they hit their target because they need to pull? That thing it has just completely crapped the bed. It crapped the whole bedroom. It crapped the house. They didn't just, man, they shit the whole mattress store, not just one bed. So I don't know what they're going to do. They missed their target. They missed their exit. Their communication strategy is terrible. They have no product to sell. They will not admit any of this. They'll say everything's fine. They'll blame it on Bitcoin, even though Bitcoin's down 1% and they're down, they're the greatest losers in the top 100 assets. They'll blame Bitcoin. It's the broader market. No, it's not. You guys are disproportionately getting punished. I think they'll have to, I think they would want to pump it. They'll get the marketing machine running and all that. I would be surprised. Let's see if they launch on July 15th, like they said. I would be very surprised. I'd be very surprised. We'll see. Maybe they will. But based on their history of repeated embarrassing failure to deliver, I would think July 15th, a little tricky for them. I mean, listen, they couldn't even inform Binance that the token is transitioning into another token. They couldn't even tell them that. Instead, Binance just put out a warning. Oh, delisting the Fetch token, which makes it look like the Fetch token's a scam. So So stupid. What a bunch of dumbasses. Anyway, yeah. I think they'll try to pump it. The question is, is it too little too late, or is there some juice in the fruit? Listen, Bitcoin runs back up. Everybody will forget about these last 60 days. No one will care. That's right. He needs 100 million. Yeah. And now he needs to sell twice as many tokens. What a hole. Yeah, I know. Anyway, stay in school. Don't do drugs. Don't do anything my poor insolvent drunk, strung out on meth grandmother or Brandon, who's definitely wearing sleeves, wouldn't do. And we will see you tomorrow. Lots of cool stuff coming for Twin Protocol. Lots of cool stuff coming. I'm going to talk to you about my in the red bag, like the stuff that I feel like is the best 5 things to buy when the market is in this the bed position. These are all trades, by the way. These are just like, in and out 2-3 month positions, but we'll talk about that and, any other goings ons. So we'll see you tomorrow. Yeah. I don't have any parting words. You don't deserve them today. You don't deserve parting words today, but I'll give them to you anyway. See you tomorrow.
If you're an accredited investor and you want in on angel, seed round or early round equity and token opportunities in the artificial intelligence and cryptocurrency space, schedule an interview at nickblacknext.com. In life, you can either be really good, really lucky, or just be first. Being first is so much easier. Schedule a digital private client interview today at nickblacknext.com.